And if you can remember, don't let me forget to turn the freaking recording thing off. So,
Okay.
That's what saves the document. Okay.
Gotcha.
All right. So good morning, everyone. This is Peter Culver, co-founder of Freedom Family Office. I'm here again today with our Chief Investment Officer, Kyle Cain. It's another edition of what we call the Freedom Flash, which is just some brief current insights on the markets today. So Kyle, would say in the last week or 10 days, we've had two interesting, surprising maybe developments in two different camps. One is we had an election that seems to have turned out a lot different than what a lot of the pundits imagined. And we've had some very good news in the short run about inflation, which has kind of lifted the markets. And so I think the question is, how should investors process those developments and other important factors that are in your mind? And I think at least here at Freedom, we have kind of two camps of clients. We have clients that are in the markets and have stayed in the markets. So how should they process those data points? And then we have some clients who have just been sitting on cash, kind of waiting for whenever the right moment is, to make some moves back into the market. So maybe you could give us your thoughts on those developments and how investors should process that.
Yeah. So, like you said, the CPI data came out and it was very, very optimistic, with the data that came out. It was a lot better than expected. CPI came in at 7.7%, which was much better than expected and down a lot from the previous highs of 9.1%. So we've seen here recently, a nice little after election rally and, significantly a rally since the inflation data points have came out. The producer price index also came out confirming, inflation is lower than expected. So this is definitely, great news. We want to see that we're past the extremes of inflation. But I think there's a few important things, and I'll touch on that first, to notice here with inflation is we certainly may be past peak inflation, and we'll see inflation coming down. You start to dissect the numbers a little bit more of, what's still sticky, what's gonna, be falling further. We're seeing a lot of the goods prices that, really kicked off the inflation in the previous years falling. Used car prices, airline tickets, things like that are falling. However, there are still some sticky elements, one being food. Food continues to come in higher pretty consistently, and that certainly affects everyone across the board. Energy has, sort of stabilized a little bit at least, which is good news. We've seen a little bit of an increase this last month in gas prices, but it's not, nothing like what we saw previously. But then the other thing is rents, rents and owner's equivalent rents. That is going to be an area that sticks around for quite a while, keeping inflation higher. So that's the bad news. The good news is that the Fed understands this. They understand that, you got to look past that a little bit further. So, the two takeaways there really is that, we've seen the path we're kind of past the peak of inflation. However, it's probably going to still be sticky and stick around for a while. So I think that, what this basically means for the markets is, what is the Fed going to do about it, right? The Federal Reserve more than likely is still going to continue to raise rates, from here. So we're not at the end yet. There's a lot of debate on where the end terminal rate will be. How high will they go? That's going to be an important driver on, growth and recession risk. But I think either way, whether it's 5% or 5.5% or wherever we are in the ending, what I think is important for investors to understand is that they're probably going to keep it there for a while. Right? They're going to keep it there until they substantially see, we need more than one data point, more than several data points, that inflation is continuously coming down to their 2% mandate. Right? So I think the rally that we're seeing is, although, warranted with some better than expected news, we're going to see that we're not at the end, and the inflation risk may have been lowering, but recession risk is still continuing to rise. As they keep, Fed funds rate higher, the longer they keep it higher, all the leading economic indicators are pointing to, slowdown in economic activity, and all the excess savings that were injected into the markets over the past couple of years by consumers are starting to dwindle. And, it's going to start eating away further at earnings, corporates' margins and their earnings over the next couple of quarters. So we want, investors to understand, just because we're past peak inflation, that's one of the things we need to see. We need to know when the Fed's going to pivot. And we're not pivot, meaning they actually start to lower interest rates. And we don't think we're there yet. We're probably more at a pause, or at some point next year, a pause rather than a pivot, which doesn't mean we're at the end. Which then leads me to the next point of the elections, right? So the elections have certainly, again, they came out, a lot of people were expecting that red wave. It's not there, but at the end of the day, we're still going to have that divided government. And what does that necessarily mean? Both pros and cons, I would say. If we do start to see the economy slowing, which is expected next year, well, with a divided government, we're probably not going to get as much of that fiscal support to prop it back up. So we're going to go back to relying on the Fed. And just as I said before, the Fed is, probably not going to shift anytime soon until we really started to see, some economic, and I use Jerome Powell's word, pain, or inflation significantly coming down. The other thing that obviously we have to be focused on, and I won't talk about it too much right now, but is debt ceiling, issues with the divided government that we may, come across. But in the end of the day, those are shouldn't be looked at as too big of a, economic momentum. So going back to what you said about, our two camps with the individuals who are invested, what should they do with this data? We've had a nice rally here. I would suggest that, we use this momentum, use this rally, this end of year rally. I'm not saying, who knows how high it'll go, but I would start to looking at a time to diversify further, to rebalance the portfolio, position more defensively with this rally, with the thought that we're going to probably see some tougher earnings over the next couple of quarters as the economy continues to cool. And just, position themselves. I don't think it makes sense to get out of the markets at these levels, but just position more defensively, healthcare, consumer staples, areas that should, continue to be able to produce, steady earnings regardless of an economic slowdown. Those that are in cash, it is an interesting time because interest rates have risen dramatically and bonds have become a lot more, attractive than they previously have. So, why sit on the sidelines when you can earn it's 4.2% right now on a 3-month, T-bill, 2 years, somewhere in that camp. It was as high as 4.7 just a couple of weeks ago. So we like the idea of starting to get some of that money to work, get it in, get it now at play, earn, a decent yield. We would still say stay on the shorter end. If you go out longer, you still may be rewarded in the long run because, again, even though I don't think interest rates will drop anytime in the next year or so, maybe in a few years out, they could drop and you could get that little extra kicker from the value of your fixed income going up, but still stay in the shorter end and, probably be looking to take advantage if the markets do start to see the poor earnings like we think may happen and a more economic slowdown in the first quarter, second quarter of next year, have that money available to take advantage and jump into the markets when those opportunities present themselves. So that's kind of a quick little, update on the capital markets, what's happening, how we think people should, be prepared. We've seen a significant sell-off and the markets will return back to their normal up days. It's been a lot of volatility, but they shouldn't just be sitting idly right now. They should be taking advantage of the current market environment, both in the capital markets, but we're also looking a lot, as always, that private markets should be a big portion of individuals' portfolios. And especially when you're going through sustained volatility in the market, there's other ways to generate return and have and diversify the risk even further than the capital market. So I know here at Freedom, we've been exploring some ideas. So Peter, if you want to discuss a little bit with us on that.
Yeah, so to maybe build out just a little bit what Kyle said, it's always been, if you think of your portfolio as a pie chart, probably our clients, anywhere from 20 to maybe 40% of their portfolio might be allocated to, generally speaking, 3 areas of the private markets: private real estate. We have a sister company that develops and operates multifamily housing. We own about 7,000 units of multifamily housing. We also lead our clients to opportunities in the private debt area and in the private equity area. And I would say together, those have 3 main themes, which are, you just used the word to describe the public markets: volatility. An interesting little factoid, which I just happened on, is in 2021, S&P 500 was up just under 24%. From January through September in 2022, the S&P 500 was down almost 24%. It's gotten a lot better since then, but a lot of clients don't like that up and down. So as Kyle mentioned, we created a new vehicle called the Freedom Opportunity Fund. It has 7 different opportunities inside it. It's an a la carte menu, not a price fix menu. You can pick the ones that you want. And very quickly, those 7 opportunities, 3 of them are specifically designed to produce really good returns, but returns that are much more stable typically than the S&P 500. So they avoid what we call large drawdowns, which is both good for compounding returns long-term. It's also good for your heart rate not to go through the up and down. There are 2 opportunities inside the fund that are income opportunities. As Kyle noted, rates are going up. Kind of boring old treasury bills are actually attractive right now, but we've got some opportunities inside the opportunity fund that are more in the 8, 10, 12% range. So they wouldn't necessarily be a substitute for that big part of your bond portfolio, but they can add some things around the margins where you can get some higher yield. And then we have an opportunity that's really a venture capital opportunity. So long-term growth, but very significant long-term growth. And there is a real estate opportunity fund inside there. So if that's of interest to you, you can go on our website, www.freedomfamilyoffice.com. If you go to the upper right-hand corner, there's a little drop-down menu. You can click on Freedom Opportunity Fund. It'll give you a summary, a detail. So, I think, maybe to summarize both of what we're saying is it's been a volatile time, maybe a trying time, but it's a time of a lot of opportunity if you keep your wits about you, both in the public markets and in the private markets. And I would just echo what you said. Almost the worst thing you can do at any time is sit on your hands. And so you can make adjustments in the public markets to take advantage of some of the changes there. And we think there's some great opportunity in the private markets. So that's today's report. And we thank you for listening. And we'll be back soon again with another update. Thanks, Kyle.
Thank you.
Now, let's see here. What do I pause, stop recording? I think that's this. After stopping you. Okay, good. Stop recording.